Hi everyone. Today we're diving into a concept every investor should know about share dilution. Whether you're new to investing or a seasoned pro, understanding share dilution and how it affects you as an investor is crucial. Let's break it down with a simple example. Imagine a company goes public and initially issues 1,000 shares at its IPO. You decide to buy 100 of those shares, which means you now own 10% of the company. Now let's say the company decides to issue 500 more shares for whatever its reasons may be. This brings the total to 1,500 shares. Your 100 shares are now just 6.7% of the company instead of the 10% prior to the issuance of new shares. That's a reduction in your ownership, and that, my friends, is share dilution. So, what exactly is happening here? Share dilution occurs when a company issues new shares in addition to the shares that are already out there. These are called outstanding shares. This process can reduce your ownership percentage, and it doesn't just affect voting power. It can impact your overall returns too. But why would a company do this? There are a few key reasons why companies issue more shares. First, companies might need to raise capital. Let's say the company wants to fund a new project, but doesn't have enough cash on hand. One way to raise money is by issuing new shares. In this case, the company carries out what's known as a secondary share issuance. It's similar to an initial public offering (IPO), but this time they're selling additional shares to investors. Another way to raise capital is through what are called convertible securities. This is basically a type of debt that can be converted into shares down the line. For example, if the company issues bonds that can be converted into equity, the debt holders might decide to convert their bonds into shares when it benefits them, which increases the total number of shares outstanding. The second reason for share dilution is mergers and acquisitions. If a company wants to acquire another business, it might issue new shares as a method of payment. Rather than using cash to buy the target company, the acquiring company can simply offer shares to the target company, and this will increase the total number of shares in circulation. A third reason, though it's quite insignificant in the total scheme of things, involves employee compensation. Many companies, especially startups and tech firms, offer stock options as part of their employees' compensation packages. This practice aligns the interests of the company's executives or key employees with those of everyday shareholders. When employees exercise their stock options, new shares are issued, and once again, share dilution occurs. I just want to emphasize the effect that this has on the total number of shares is significantly less than, let's say, share dilution that occurs for mergers and acquisitions or to raise capital. So, we know why companies value shares. But now let's dive into the real question. Is share dilution good or bad for investors? First, let's look at potential downsides. If a company issues more shares but doesn't increase its profitability or improve its operations, it will almost certainly be detrimental to shareholders. More shares mean more people are entitled to a piece of the company's profits. And if those profits don't grow, the earnings per share decrease. This is important because lower earnings per share often leads to a decrease in stock price, hurting the value of your investment. Let's say you own one share of a company that makes $25 million a year and has a total of 5 million shares. In this case, your share of the profits is $5, which is the earning per share, because you own only one share. But if the company issues 1 million more shares, bringing the total to 6 million, and the profit remains at 25 million, your earnings per share drops to $4.17. You now own a smaller portion of the company's profits, which could negatively affect the stock price and your returns. Another thing to keep in mind is that when companies issue new shares, they often sell them at a lower price than the market value of existing shares. This can reduce the value of your holdings as the average price per share decreases. Side. Share dilution isn't always bad. If a company raises capital and uses it effectively, say to fund a high growth project or acquire a valuable business, it can increase the company's profitability in the long run. In this case, the dilution is offset by the company's growth. Let's go back to our example. Suppose the company issues 1 million more shares, bringing the total to 6 million. But instead of the profits staying at 25 million, this time the company uses the raised capital to expand its operations and increase its profitability. Now the company is making $35 million a year. With 6 million shares and $35 million a year in profits, the earnings per share would equate to $5.83, higher than before the dilution. So even though you own a smaller percentage of the company, your actual share of the profits is larger because the company is generating more revenue. This kind of scenario shows that share dilution, when used correctly, can actually benefit shareholders in the long run. In conclusion, if a company issues more shares but fails to grow its profitability, investors end up owning a smaller slice of the same pie, which can hurt the stock price. On the other hand, if a company uses the capital it raises from share dilution to expand its business and increase profits, the pie grows and investors can come out ahead. For investors, it's important to look at why a company is issuing more shares. Is it raising capital to grow, or is it simply diluting shares without a clear plan for profitability? By understanding the reasons behind share dilution, you can make more informed decisions about your investments and determine whether or not it's likely to be beneficial in the long run. Thanks for tuning in, and I hope this video helps you understand share dilution better.